We all tend to be so busy with the things that we have coming up. But sometimes it's just good to take a step back and look back and see all the stuff that we've left behind. So here are 3 interesting things that happened this week. Hello, and thank you for joining me for another awesome episode of the Slow Money Club podcast. Now, this week we've got a few interesting things that I want to talk to you about. And to begin with, I guess, it was a special day in the history of Bitcoin, but not how you may think. Demand for building materials has been skyrocketing, and with inflation on the horizon, is gold still a good inflation hedge? But first, a story about Bitcoin and pizza. I'm sure you've read a lot about Bitcoin over the last week, so I'll do my best not to bore you. Last week was a very special day in the history of Bitcoin though, because on the 22nd of May 2010, the first purchase of goods in Bitcoin happened. What was this pioneering purchase? 2 pizzas, bought for 10,000 Bitcoin, the equivalent of $41 at the time. Even back in 2010, this was a lot for 2 Papa John's pizzas. A decade later, those 10,000 Bitcoin have been worth as much as 630 million when Bitcoin hit its all-time high. And I thought I had made some bad financial decisions. So what does a decade of technical data on crypto tell us? Well, crypto assets are still very new compared to more mature asset classes like shares and bonds, but this is not to say that we don't have any information on them. They're not as new as they were when a couple of guys were trying to figure out how to buy pizza with it, for example. And so looking back at the historical data of Bitcoin over the last couple of collapses, the last collapse was in 2017. That was the last major collapse. This was the supply reduction year, halving as it's called, the previous year in 2016. The dip from 2017 lasted until 2019. Halving also happened in 2020. We've had the dip in 2021. And since the all-time high of Bitcoin earlier this year, the price of crypto have basically collapsed. Since 2010, the average fall from the record highs have been 50%. As the number in dollar terms has gotten more and more, we've noticed that bigger and bigger news has been made out of all of this. But is volatility bad? There have been a lot of negative news about crypto for sure. But what if I told you that there was a company whose shares fall on average 31% a year? And that on 5 occasions, the shares of the company have fallen over 50%. Twice it's fallen over 90%. In the first few years, the volatility averaged over 100%. Last year, it fell 20%, then rose 90% before falling nearly 15% again. Any idea what this listed company with an average 80% volatility in its 24 years could be? Bitcoin shares this metric with the world's dominant seller of goods on the internet, Amazon. So volatility can be your friend. Yes, Amazon stock has had a similar level of volatility to Bitcoin, especially in its first decade. And according to Bloomberg, Bitcoin appears on track to become less volatile than Amazon in the next couple of years. Volatility will only continue with Bitcoin until the market cap reaches a certain level of depth, i.e. the number of people that hold Bitcoin. And so can it be a digital reserve currency, or is it always going to be a speculative trading bet? And Bitcoin is rare in that it's got a fixed supply, fixed mining schedule, and really that plays an important role in the supply demand dynamics, especially also in the price discovery, because Bitcoin's annual price has grown by 223% a year in the 11 years that it's been around, which is just ridiculous. Some would argue that the whole volatility element is what investing is all about, and there's no point investing unless you have volatility, but that's a speculator's game, I guess. Its unique attributes, Bitcoin, has propelled it to a status as the world's digital reserve currency, and it really has a unique position amongst the 8,000 or so cryptos that exist out there. So volatility can invoke emotional responses from people, especially when it comes to crypto. And I personally don't think that the volatility is about to stop anytime soon. Always remember though, your money, your capital is at risk. The second thing I wanted to talk to you about is a construction material shortage. So if you're in property as an investor, developer, it won't have surprised you that the reopening, as needed as it's been, has led to a tale of two cities. In London, in particular, you can't help but have noticed the skyline over the last few weeks, and you would have seen the speed and scale at which large new cranes have been cropping up. The construction industry has been experiencing a different pandemic to other industries like the restaurant industry or the retail industry. In the construction sector, costs are basically rising at the fastest price since 1997. There's a construction boom going on not just in the UK, but around the world as governments try to build themselves out of this pandemic. The UK housing sector remains underpinned by massive supply-demand imbalances, which have been exacerbated by this pandemic, and is leading to near double-digit inflation in some areas. Last week, IHS Markit released the latest PMI data. It showed that overall construction costs were rising at the fastest pace for 24 years. In the survey, construction firms also said that new orders were rising at the fastest pace they'd seen for almost 7 years. Official data from the Office of National Statistics, I can never say that word, Office of National Statistics showed that construction and infrastructure was the first sector to exceed the pre-pandemic output levels, and that was way back in November last year. Then, in April this year, the government said that it would allow construction companies to claim a super deduction. That means they can claim 130% of all new plant and machinery. Wouldn't you take advantage if you could? I know I would. And it's not just private companies taking advantage. Civil activity has also been increased since April, with Highways England seizing on this opportunity to fast-track some of their projects. And as infrastructure projects like HS2 begin to ramp up post-pandemic and post-lockdown, it's inevitable that the impact they'll have on supply-demand is going to be huge. So there's a demand boom, and demand for building materials has been skyrocketing. As a result, house builders are trying to catch up. This is creating massive shortages of construction materials such as aggregates, timber, steel, cement, concrete products in general. High international demand is also preventing some of the UK buyers from being able to rebuild their stock and go out into the international markets and pick that up. On the one hand, you have strong demand, which is contributing to rising costs. On the other hand, it's leading to much longer wait times for deliveries. The key items that are really in short supply right now include things like timber, roof tiles, roof membranes. Timber has seen an upping in demand, in part because of the renewed focus on green energy and net zero construction. Timber has a large carbon storage potential, so people want to use more of it in constructions now. Imported wood prices rose by 16.6% in March. There's also a shortage of stock for raw materials such as polyethylene and polyurethane and polypropylene. All of these are used in plastic pipes, so meaning plastic prices are going up. You get the picture. Last week, British Steel stopped taking orders for new structural steel sections. Why? Because they said they've seen extreme demand. There are concerns that what they've done is really just led to panic buying as more and more people try to just stock up. But this is making things worse, and fabricated structural steel prices rose by 17.6%. The elephant in the room is Brexit, and Brexit complications haven't helped. In some cases, 80% of construction materials come from Europe. For new builds, this can be as much as 90%. That's according to the Department for Business, Energy and Industrial Strategy. On the positive side, cement is one material where the vast majority is used in the UK is actually manufactured in the UK as well. But this hasn't stopped cement from being listed on the items facing shortages. Supply has also been hit by production constraints because hauliers are struggling to find people to drive the cement around the country, and prices are up 19.8%. The booming demand has led to booming demand for workers as well. And this is the other element of it, where we're seeing contractors in the commercial market have had a surge in demand for work. As many as labourers are seeing as much as 50% increase in their wages on the one hand. On the flip side, Hayes is saying we're seeing a 50% growth in vacancies. The skills gap is really a long-term issue. Employers are beginning to identify that there is a big skills gap in the construction sector and demand and supply not matching up. According to the Office of National Statistics, 113,000 EU-born professionals currently work in the skilled construction sector. That's down from 208,000 100,000, or almost 50% in the last 12 months. So there's a massive skills shortage going on, which is adding to all of this. The last thing that I really want to leave you on is that as we've discussed, everything is inflating, not just in construction, but in the general economy. How do you protect yourself against this inflation? And is gold still a good inflation hedge? The third thing that I wanted to talk about is gold still a good inflation hedge? So, the benefits of recovering from a global pandemic are clear, but the downside is that it leads to inflation, like we've just been talking about. And if inflation really does take hold this year, you definitely won't be able to say that you weren't warned. I've been talking about it. And more recently, even the legend Warren Buffett has joined the growing ranks of nervy inflation watchers. We've seen a very substantial inflation. It's very interesting. I mean, we're raising our prices, people are raising prices for us, and it's being accepted. The costs are just going up and up. Steel costs, every day they're going up. But there's more inflation going on quite a bit more inflation going on than people are anticipating or were anticipating just 6 months ago. That was Uncle Warren. Hope you like my Warren Buffett impression. The supply squeeze has meant that commodities from copper to iron ore, lumber and corn have all skyrocketed. Most of them have seen double-digit increases and they are record highs. We really are in this next commodity super cycle. Gold is often seen as an asset that can benefit from rising inflation. This is because progressively the rising prices of things and actually the decrease in buying power of cash go hand in hand. And inflation progressively reduces the buying power of cash. That means that you can actually buy more gold with that cash, you see? The fact that this can happen, or this has been happening for so long, has meant that people believe gold to be an inflation hedge. But is this really true, even in today's world? In fact, gold has been a poor protection against inflation. For example, in 1975, when inflation was at 25%, well, gold prices actually fell. Yeah. Since the global financial crisis, the subsequent European sovereign debt crisis, the link between gold and inflation has grown even weaker. Part of this is down to QE, which was unleashed post-financial crisis, and most of that flowed into financial assets like shares, bond and property, as opposed to physical assets like gold. So consumers missed out and inflation stayed low. I would go as far as to say, though, that if gold was really a great short-term inflation hedge, then its price in real terms would never fall. That is, adjusted for inflation. Unless there was deflation, because inflation is always going up, so gold prices should always be going up, right? Well, also when things are going really well, investors tend to dump safe haven assets like gold in favor of more risky assets like shares. So again, I don't necessarily think that bodes well for gold. The crux of it, though, is that inflation isn't guaranteed, and in fact, central banks disagree with Uncle Warren about the potential direction for inflation. The Bank of England expects only an uptick in inflation, and this will be modest and transitionary. Over the medium term, economic slack may absorb some of this. There will be deflationary factors in the economy like technology and innovation, so inflation might not be as high, or not all of it might not be passed down. But I guess the upshot of all of that is, regardless of whether or not we have positive inflation coming, you need to hedge against it in some way. And can gold do that? Probably not. So that has been 3 things that happened this week. Hope you've enjoyed it, and I'll see you next time for 3 more things that happen next week.
If you'd like more information on what you just heard, go to slowmoneyclub.com and join the club.